All right, let's jump right into this explainer. Today, we're uncovering why hidden structures, and honestly not just raw information, actually dictate the outcomes in crypto markets. We spend so much of our time obsessing over the latest charts, news drops, or whatever market tip is trending. We're constantly trying to just learn more facts. But today, we're going to look beneath all that. We're going to explore how the invisible architecture of a system is actually what decides who wins, who loses, and exactly how value is either created or destroyed.
70 to 90%. That is the staggering failure rate of retail traders over any meaningful time period. It's a massive, pretty sobering number. And the usual excuse we hear for this? People just assume these traders don't know enough. They think, like, if they had just read one more technical analysis chart or bought one more online course, they'd magically be profitable. But the data actually tells us that this information-first model, it's mostly wrong.
The real culprit here is structure, not knowledge. Every single trade you make carries transaction costs, things like spreads, fees, and slippage. That creates a negative sum baseline before you've even made a decision. Honestly, even a perfectly rational, emotionless robot trader would bleed money over time just from this built-in friction alone. So it's the actual structure of the game, rather than a lack of knowledge, that creates this baseline for failure.
So let's break this down into parts. Phase 1, the microstructure, or human behavior. To really grasp this, we need to look intimately at why our own psychological wiring sets us up to fail. Before we talk about massive market crashes or crazy new tokens, we have to understand the flawed process running inside our own minds. We literally have this structural habit of letting our losing trades snowball, right? When a trade goes bad, human instinct begs us to add to the losing position just to bring down our average entry price. But when we're winning, that profit feels so incredibly fragile that we just close it out early to protect it. Mathematically speaking, we're building an architecture where our losers are always huge and our winners are always tiny.
Now combine that emotional baggage with the constant friction of spreads and fees, and active traders are basically being trained to learn the exact wrong lessons. The market feeds you highly misleading short-term feedback. Like, say you take some insane leverage and happen to win. The market rewards you with profit, which basically teaches your brain that reckless risk is actually a smart move. It's this dangerous feedback loop that gradually pushes traders toward total overconfidence, structurally programming them for an inevitable wipeout. Which brings us to phase 2, the macro structure and systemic failure. Let's scale this up from individual habits to a protocol-level catastrophe. We have to revisit the legendary Terra Luna crash of 2022. As a quick refresher on its doomed architecture, remember that unlike a traditional stablecoin backed by actual US dollars sitting in a bank vault somewhere, an algorithmic stablecoin has zero external fiat collateral catching its fall. It relies entirely on its own native tokens and smart contract algorithms to somehow maintain that $1 peg. Now, looking at Ledger's academic analysis of this, Terra relied on what looks like a beautiful closed-loop arbitrage system. The theory was actually quite simple. It basically harnessed independent arbitrage traders to keep the system perfectly stable. If Terra USD or UST went above $1, you mint it and sell it. If it dropped below $1, you buy it cheap, redeem it for exactly $1 worth of Luna, and sell the Luna. Boom. A continuous cycle meant to balance out any market pressures. But reality absolutely shattered that theory. The divergence we saw was just wild. On one hand, the minted Luna supply went absolutely through the roof, while at the exact same time, the swapped value crashed into a total death spiral. Because of a deep structural flaw in the virtual liquidity pool, users who are swapping massive amounts of UST ended up getting way less Luna value than they actually should have. Arbitrage traders realized they could exploit this, aggressively dumped, and forced the protocol to hyperinflate the Luna supply just to try and cover the cascading panic. And the catastrophic outcome? A 4 million-fold decrease. Luna dropped from its high of almost $120 to practically zero in May 2022. It wasn't just a panic or some run of bad luck. The system did exactly what its underlying code dictated it to do when put under intense market stress. The structural incentive to arbitrage literally became a structural guarantee of total collapse. All right, let's pivot to phase 3, the novel structure, focusing on protocol innovation. Let's look at the absolute cutting edge right now to see how developers are inventing totally new market structures today. Enter Unipeg. It's an experimental new token whose market cap just surged past $11 million because it completely flips the psychology of trading on its head. What if trading wasn't just about moving digital numbers around? What if the architecture of the trade itself created something entirely new? This innovation literally turns a standard token swap into a generative act. Here's how it works. Unipeg uses Uniswap v4 hooks to cleanly break down the trading process. Hooks are this brand new feature in Uniswap that let developers inject custom logic right into the middle of a trade. So step 1, a user pushes a trade through the pool. Step 2, the hook grabs data from that exact transaction and instantly generates a unique hash. Step 3, an on-chain renderer spits out a unique 24 by 24 pixel art unicorn. The market activity itself is literally generating the art in real time. The underlying structural logic here is brilliantly simple. If you hold a fractional balance, you just hold a regular token. But the second you cross over an integer threshold, say going from 0.9 to exactly 1.0, bam, you suddenly hold a displayable NFT. It merges the easy divisibility of an ERC20 token with the uniqueness of an NFT without having to awkwardly swap between the two. The code structure dictates that your numerical balance directly changes what you actually see and hold. Buying and selling isn't just math anymore, it's collecting. And a fun fact here, this clever structure actually revives a discarded name from way back in 2018. Before Uniswap was officially named, founder Hayden Adams was playing around with the name Unipeg, like a mix of unicorn and Pegasus. Fast forward to today, with the explosion of on-chain JPEGs, the community repurposed it. Uni plus JPEG equals Unipeg. It's just a perfect linguistic match for a completely novel market structure. So what is the common thread running through all of this? Whether it's the psychological habit of a retail trader, the completely flawed token and economics of Terra, or the highly innovative code logic of Unipeg, the invisible structure always dictates the outcome. We've seen how internal emotional friction creates guaranteed losses. We've seen how algorithmic incentives can print a currency into oblivion. But we've also seen how altering the structure of a basic token swap can give birth to generative art. The underlying architecture is quite literally everything. So I want to leave you with this question as we wrap up this explainer. As you navigate these markets, are you just frantically trying to learn more facts, or are you actually building a winning process? Because as we've seen today, you can have all the information in the world, but if your underlying structure is flawed, whether that's in your personal trading habits or the protocols you use, you are mathematically destined to fail. Focus on the architecture. Build your process.